In traditional statistics, there is this fundamental rule that you learn on day one.
Oh, yeah, day one stuff.
Right. And it basically goes like this. If you have a data set with, say, 100 observations, you absolutely cannot use a model with 150 variables.
Right, the math literally just breaks down.
Exactly. It's like trying to solve a puzzle where you have way more missing pieces than you have actual clues. The whole system just fails.
Yeah, you hit a wall.
But the wild thing is, if you look closely at the architecture of the most successful, like incredibly profitable automated trading platforms operating today, they're doing exactly that.
They are intentionally breaking the rule.
Yes. They are throwing thousands of variables at limited data sets, and instead of the models breaking, they are somehow predicting market movements with this terrifying accuracy.
It completely inverts the classical rules of econometrics. I mean, we are entering this mathematical regime where traditional models tell us we should be completely failing, but empirically, we're achieving the highest possible out-of-sample performance.
Which is just wild. So welcome to this deep dive. Our mission today is to really decode how machine learning is just fundamentally revolutionizing financial systems.
Specifically focusing on the backtesting engines, right?
Exactly. How these highly complex, rule-breaking concepts are applied to optimize the backtesting engines that power today's leading automated trading platforms.
It's a massive topic.
It is. And we are pulling from an incredible stack of sources today for you. We've got these dense foundational texts like learning theory from first principles, comprehensive overviews on machine learning and finance, and some really cutting-edge systematic reviews analyzing applications between 2024 and 2026.
And the context for these sources is just critical for you listening because the financial market is arguably the harshest environment on earth for data analysis.
Oh, without a doubt.
I mean, if you compare it to other fields where AI has triumphed, like image recognition or natural language processing, the environment's just completely different.
Right, because an image of a dog is always an image of a dog.
Exactly. The pixels have a stable, measurable relationship to the core concept.
The dog doesn't randomly change shape because interest rates went up.
Right, exactly. But financial data, it has this brutally low signal-to-noise ratio. You are sifting through this relentless avalanche of noise just to find a microscopic, fleeting grain of actual truth.
And even when you find it, the relationship between the data and the truth is constantly mutating.
Okay, let's unpack this because I want to acknowledge up front, if you flip through these papers, you are met with a literal wall of stochastic calculus, matrix algebra, algorithmic theory.
It looks completely impenetrable.
It really does. But we are going to translate this. We're going to break down the actual mechanics of how these systems learn to trade. But to do that, we need to start at the beginning.
Before we even look at an automated trading system, we have to understand the environment it operates in.
Right. Like, why can't a modern quant fund just use old-school statistical models? Why do we even need artificial intelligence to buy and sell stocks? Well, to answer that, we have to look at the foundational assumptions of traditional finance. And that is built on a field called econometrics.
Econometrics, okay.
Yeah, and in econometrics, the ultimate goal is to understand the underlying truth of the market through rigid economic theory.
So you're building a model based on a fixed equation.
Exactly. Let's take a classic ARIMA model, which stands for Autoregressive Integrated Moving Average.
Right, standard stuff.
Very standard. When a traditional financial analyst uses an ARIMA model, they are essentially planting a flag in the ground and saying, I believe the market works according to this specific mathematical rule.
They're saying today's price is a linear combination of past prices and past errors.
Yes. So they are forcing a very specific human-designed structure onto the data.
Before the data even has a chance to speak for itself.
That is the core of the issue right there. You predefine the theory. You assume that what we call the data-generating process, the invisible mechanics that actually create the market prices.
That it can all just be neatly summarized in a human-readable formula.
Right. But financial data is uniquely difficult. It's characterized by massive information sets and incredibly ambiguous functional forms.
And it's non-stationary.
Highly non-stationary, meaning the statistical properties of the market today are fundamentally different than they were a decade ago.
Or even a week ago, honestly.
Exactly. So an ARIMA model might work beautifully in a hypothetical, perfectly stable economy where human behavior never changes.
But the second the market regime shifts, like, say, a central bank unexpectedly raises interest rates, that rigid equation just snaps.
It breaks entirely because the underlying assumptions of the data-generating process are completely violated.
So how does machine learning fix that?
Well, machine learning approaches the problem from a completely different paradigm. It doesn't care about finding a beautiful, unifying economic theory.
It just abandons the search for an elegant truth.
Right. It operates under the assumption that the data generating process is impossibly complex, constantly shifting, and, frankly, fundamentally unknowable to the human mind.
It just asks, what is mathematically working right now?
Yes, exactly. It acts as a non-parametric estimator. So instead of rigid equations, it uses flexible architectures. Things like decision trees, deep neural networks, kernel methods.
Just trying to approximate these unknown, super complex functions.
Right. Because in traditional finance, the focus is almost always on in-sample explanation. Like, can I build a model that beautifully explains why the 2008 financial crisis happened?
But in machine learning, for trading, you don't care about explaining the past.
Exactly. The focus shifts entirely to out-of-sample prediction. The algorithm doesn't care if it can explain the past perfectly. It only cares if it can accurately predict the unseen, completely novel data of tomorrow.
But hold on, this brings up a massive counter-argument that, traditional statisticians are always hurling at machine learning.
The overfitting argument.
Yeah, exactly. If we agree that the market is predominantly noise, and you deploy this hyper-flexible neural network that can mold itself to literally any shape, doesn't it just memorize the noise?
That is a very valid fear.
Like, think about a high school student taking a standardized test. If the student takes the exact same practice test 50 times, they will eventually just memorize that the answer to question 4 is C and question 12 is A.
Right. They haven't actually learned the underlying math.
They've just memorized the noise of that specific practice test. And when they sit down for the actual exam with different questions, they fail catastrophically. So, isn't a highly flexible AI doing the exact same thing with historical market data?
That is the ultimate pitfall,
Uh-huh.
and the industry calls it overfitting. If you just let a raw neural network loose on 10 years of historical tick data, it will absolutely memorize the practice test.
They'll just find spurious correlations.
Exactly. It'll learn something crazy like every time it rains in London on a Tuesday, Apple stock goes up by 2 cents, and it will build trading rules around those illusions.
Wow.
But this is where the literature introduces a mechanical safeguard. It's a core concept called regularization.
Okay, I want to dig into the mechanics of this because regularization is one of those buzzwords that gets thrown around in pitch decks all the time, but it rarely actually gets explained. How does it stop the algorithm from memorizing the practice test?
Well, regularization is essentially a mathematical penalty for complexity.
A penalty.
Yeah,
Okay.
let's look at it during the training phase of an algorithm. The neural network is iterating, right? It's constantly tweaking its internal weights to minimize its error on the historical data.
And left to its own devices, it will use every single variable it has to perfectly fit every single historical price tick.
Precisely. So regularization introduces an artificial constraint into that optimization function. It mathematically tells the algorithm, I am going to punish you for every new parameter you add and for how heavily you rely on any single variable,
Unless what?
unless that variable genuinely and massively boosts your predictive accuracy.
Oh, so it forces the algorithm to be cynical about its own discovery.
Yes, very cynical.
It can't just casually link the rain in London to Apple stock because the regularization penalty demands overwhelming proof that the connection is universally robust, not just some historical fluke.
It acts as a strict editor. Later on, we are going to dive deeply into specific techniques like ridge regression and the L2 penalty.
Which are the actual mathematical tools doing this.
Exactly. They mathematically crush the weights of those spurious correlations all the way down to zero.
Hmm.
So regularization prevents the hyperflexible model from molding itself perfectly to the noise.
Forcing it to extract only the broad, generalized patterns that actually have predictive power for unseen data.
Exactly.
Okay, so we've established that traditional, rigid equations are just too brittle for the market, and we need flexible machine learning models heavily constrained by regularization.
Correct.
But if you are building an automated backtesting engine, before you can train your regularized model, you have to feed it data. And the sources reveal a fundamental flaw in how the entire financial industry has historically structured its data.
It is a massive systemic blind spot.
Right, relying on the clock to measure the market is mathematically broken.
Yes. For decades, the industry has relied on what Marcos Lopez de Prado, who is a pioneer in financial machine learning, he critiques this as the fixed time horizon method.
Which is how everyone looks at charts.
Right. When you pull up a stock chart on your phone or your professional terminal, you are looking at data sliced into fixed time intervals. You look at the daily close, or an hourly chart, or a 5-minute chart.
You are organizing the information by the passage of time, which, to be fair, feels completely intuitive. Humans live by the clock. We want to know how much money we made today versus yesterday.
But what is the fundamental flaw with organizing data that way?
Well, the flaw is that markets don't care about human schedules.
Not at all. Market volatility, liquidity, information flow, it all changes dramatically and sporadically. By using fixed time bars, you are treating a sleepy Tuesday morning in mid-August exactly the same as the chaotic 15 minutes immediately following a surprise interest rate hike by the Federal Reserve.
You are taking a fixed slice of time, but the amount of actual market information inside that slice is wildly inconsistent.
Exactly.
Let me offer an analogy to help visualize why this just breaks statistical models. Imagine you are an urban planner trying to understand the flow of traffic at a major complex intersection in a city.
I like this.
And you set up a camera to take a photograph exactly once every hour. Those are your time bars. At 3 a.m., the camera snaps a picture of a completely empty road.
Right, zero traffic.
And then at 5 p.m., during the peak of rush hour, it snaps a picture of a chaotic, congested blur of cars. Now, the parameter you controlled, the time, is perfectly constant. An hour is an hour.
But the information you were trying to study is uselessly distributed.
Exactly. The 3 a.m. photo has zero data, and the 5 p.m. photo is so overwhelmed with data that you can't even decipher individual vehicle behavior.
That analogy maps perfectly to the mechanics of financial data. In finance, those empty road periods mean you are feeding your algorithm redundant, zero information data.
Which artificially inflates your confidence in market stability.
Right. And during the rush hour periods, the massive price swings are all compressed into a single bar, hiding the microstructural dynamics that your algorithm actually needs to learn from.
It's just a blur.
And furthermore, traditional statistical models, even machine learning models, they prefer data that follows a normal distribution. The classic bell curve.
Right. The math likes normal data.
But time bars notoriously create distributions with massive skewness and what we call fat tails, meaning extreme, unpredictable events happen far more often than the math expects.
So if snapping a photo every hour is the wrong approach, the alternative proposed in the sources is data parsing as bars, specifically activity-based bars.
Yes, activity-based.
So instead of programming our traffic camera based on the clock, we program it based on the cars. We tell the camera, take a picture every time exactly 100 cars pass through the intersection.
That's exactly it. And in the context of a backtesting system, this means transitioning your entire database to tick bars, volume bars, or dollar bars.
Let's break those down.
Sure. A tick bar closes and prints a new data point after a set number of individual trades occur, regardless of how big those trades are.
Oh, okay.
A volume bar closes after a specific number of shares or contracts have changed hands. And a dollar bar, which is often considered the most robust, closes after a specific monetary value has been exchanged.
Think about the implications of that during a market crash. If panic selling sets in, $1 billion might change hands in 60 seconds.
Right. Massive activity.
So if you are using dollar bars, your system might generate 500 data bars in that single minute, capturing every tiny micro movement of the crash in high resolution.
Yes.
But during a quiet holiday trading session, it might take 4 hours to generate enough monetary exchange to print a single dollar bar.
You are allowing the market's activity to dictate the sampling rate. And the sources provide empirical evidence for why this is just mandatory for automated trading.
What's the evidence?
There is a specific analysis in the text looking at weekly bar counts from 2013 to 2014. If you plot time bars, it's just a flat, continuous horizontal line. You always get the exact same number of daily bars in a week.
Right, obviously.
But when you plot tick, volume, or dollar bars, the chart fluctuates wildly. It spikes during periods of high information flow and drops during lulls.
It looks like an electrocardiogram. It's actually capturing the heartbeat and the stress level of the market.
And the mathematical payoff is profound here. When researchers take autoregressive models and fit them to the market returns using these activity-based bars instead of time bars, the predictive accuracy jumps significantly.
Why is that?
Because sampling based on activity pulls the distribution of the returns much closer to a normal Gaussian distribution.
It fixes the fat tails.
It doesn't completely eliminate them. Financial markets will always have some extreme outlier events.
Yeah.
But it stabilizes the statistical properties of the data. The variance becomes much more constant.
So, if you are building the foundation of a backtesting engine, translating your historical data from a clock-based grid to an activity-based grid is literally the non-negotiable first step.
Without a doubt, it's step one.
All right, so our engine is now consuming volume bars. We have fixed the data ingestion. But if we are running a backtest, how does the system evaluate if a historical trade was successful?
We need to define the finish line for the algorithm.
Right, and this brings us back to the flaw of relying on time.
Exactly. Just as time bars distort the data inputs, relying on time distorts the training labels.
The labels that teach the AI.
Right. In standard classical backtesting, the researcher will often label an observation by checking the price after a fixed time horizon. For instance, the rule might be, buy the asset, wait exactly 5 days, and if the return exceeds 2%, label this trade as a 1 for success.
Which is completely insane if you think about actual life trading.
It makes no sense.
No professional trader enters a massive position, goes to sleep for exactly 5 days, wakes up, and casually checks if they made money. You are managing the trade every second it is open.
Exactly. It ignores the fundamental concept of path dependency.
Right.
If your automated algorithm buys a stock at $100 and over the next 3 days it drops to $70 before magically rallying to $105 on day 5.
A fixed time horizon backtest would just look at day 5, see a 5% profit, and label the algorithm's entry as a massive success.
But in the real world, your risk management system would have liquidated that position when it hit $90.
You would have been stopped out. You wouldn't have survived the drawdown to see the rally.
Right. So the fixed time backtest is teaching the algorithm that devastating drawdowns are acceptable, which is a quick way to bankrupt a fund.
So to solve this, the literature advocates for a framework known as the triple barrier method.
Yes, the triple barrier method. This is how you accurately label training data for a machine learning model so it actually learns the reality of trade management.
Let's break down the mechanics of the triple barrier. We are essentially building a cage around the trade the moment it is executed.
You can visualize it as a box with 3 walls. You have 2 horizontal barriers and 1 vertical barrier.
Okay.
The upper horizontal barrier is your profit-taking target. The lower horizontal barrier is your stop-loss limit, and the vertical barrier is a maximum time expiration.
Like the absolute longest you are willing to tie up capital in this idea before forcing an exit, regardless of profit or loss.
Exactly.
Okay, so far that just sounds like standard trading 101, target, stop loss, time limit. How does this integrate with the complex machine learning architecture we're discussing?
The innovation lies in how those horizontal barriers are calculated. In a retail trading scenario, someone might say, I always use a 2% stop loss.
Right, a fixed percentage.
But in an institutional machine learning system, fixed percentages are just as flawed as fixed time bars.
Yeah.
The triple barrier method mandates that the upper and lower barriers are dynamic.
Dynamic. Okay, based on what?
They are explicitly formulated based on the current real-time volatility of the asset, which is typically denoted mathematically by the Greek letter sigma.
Sigma. Okay, I want to make sure the mechanics of this are crystal clear. How is the system dynamically calculating sigma in real time to adjust these walls?
Usually the system calculates an exponentially weighted moving average of the recent returns, often using those volume bars we just discussed, to gauge how violently the asset is swinging.
So it's looking at the recent past to judge the current turbulence.
Right. If your algorithm initiates a trade during a period of massive macroeconomic uncertainty, the calculated sigma will be extremely high.
And what does the system do with that high sigma?
The system takes that high sigma and mathematically widens the upper profit barrier and the lower stop-loss barrier. It gives the trade a wider berth to breathe, because normal everyday noise is suddenly much larger.
That makes perfect sense, because if you kept a tight 2% stop loss during a volatile market crash, you would be stopped out by random noise within seconds. The algorithm has to recognize that the definition of noise has expanded.
Precisely. Conversely, if you enter a trade during a low volatility, quiet market regime, sigma is low.
So the triple barrier method automatically tightens the horizontal barrier.
Yes, because a 1% move in a low volatility environment is highly significant, whereas a 1% move in a high volatility environment is statistically meaningless. By dynamically adjusting these barriers based on sigma, you ensure that your definition of success and failure scales with the market conditions.
And this directly creates the labels that train the neural network.
Right.
We talked about supervised learning needing labels, like flashcards for the AI.
Yes. Once a trade is initiated in the backtest, the algorithm tracks the price path.
Inside that box.
Inside the box. If the price hits the dynamic upper profit barrier first, the observation is labeled with a 1. If the price hits the dynamic lower stop-loss barrier first, it is labeled with a -1.
And what if it hits the vertical time wall?
If the price just meanders and eventually hits the vertical time barrier without touching either horizontal wall, it's typically assigned to 0, or sometimes a -1, depending on how heavily you want to penalize dead capital.
This completely changes what the algorithm is learning. It's no longer just trying to guess the final destination of the price.
No, it is learning the turbulence of the flight path.
It learns to identify setups that not only go up, but go up smoothly enough to avoid triggering a volatility-adjusted stop loss.
It bridges the gap between statistical forecasting and actual portfolio management. But once you have this incredible data structure and you have these robust volatility-adjusted labels,
You face the next architectural challenge.
right, how does the system actually synthesize the data to make a trading decision? And this brings us to a concept that completely rethinks algorithm design: meta-labeling.
Meta-labeling. Yeah, when I first read this section of the sources, I had to read it twice because it completely defies the way you naturally assume a supercomputer would operate. Well, you naturally assume that if a hedge fund has a massive supercomputer, they build one giant omnipotent neural network. You feed it all the volume bar, all the macroeconomic data, the triple barrier limits, and it spits out a master command like, buy 10,000 shares of Microsoft right now.
Right, the monolithic AI approach.
But the literature says that single model approach is totally suboptimal.
It goes back to a foundational statistical problem known as the bias variance trade-off, specifically applied to competing optimization objectives.
Competing objectives.
Yes, when you ask a single machine learning model to do everything, you are asking it to solve two very different mathematical problems simultaneously. First, it has to figure out the directional signal. Is this asset going to go up or down?
Right.
Second, it has to figure out the risk-adjusted execution. How confident am I in this signal? And given the current market volatility, is it worth risking capital?
Ah, I see. It's trying to be the visionary analyst generating ideas and the paranoid risk manager allocating the budget at the exact same time.
And historically, when a single model tries to optimize for both of those things, it ends up compromising.
It does a mediocre job at both.
Right. It might find a decent directional signal, but miscalculate the sizing. Or it might become so obsessed with risk management that it filters out highly profitable trades. Meta-labeling solves this by physically separating the architecture into two distinct cascading models.
A primary model and a secondary model.
Exactly.
Okay, let's walk through the exact pipeline of how a trade moves through this split system. What does the primary model do?
The primary model's mandate is radically simplified. It is only allowed to think about direction.
So no risk management at all.
None. It doesn't care about trade sizing. It doesn't care about risk. It could be a simple econometric model, a moving average crossover system, or maybe a smaller neural network with a limited set of parameters. Its only job is to look at the data and output a directional signal, one for long or -1 for short.
So it's essentially raising its hand and saying, based on my limited view, I think the momentum is shifting upwards. But it is completely barred from actually executing a trade or accessing capital.
Exactly. The primary model is just an idea generator. It creates a massive list of potential trades, but then those ideas are passed to the secondary model.
And this is where the big guns come out.
This is where the heavy machine learning firepower is deployed. The secondary model is a highly complex nonlinear model, perhaps a deep neural network or an advanced gradient boosting machine like XGBoost.
And its objective is fundamentally different, right?
Yes, it is not trying to predict if the stock is going up or down.
This is the part that is so counterintuitive. What is it predicting?
It is predicting whether the primary model is right or wrong.
Wow.
The secondary model takes the signal from the primary model, but it also ingests a massive separate feature set. It might look at the relative strength index, complex autocorrelation metrics, order book imbalances, and volatility across multiple timeframes.
And the training labels for this secondary model.
They are strictly binary. A 1 if the primary model's idea would have successfully hit the upper triple barrier, and a 0 if it would have failed.
It is essentially an AI whose sole purpose is to audit another AI. I just love this concept. But I do want to push back on the architecture here for a second because it feels like we might just be moving the goalposts.
How so?
Well, if the secondary model is ingesting thousands of complex variables to decide if the trade is safe, why not just let it make the directional prediction too? Why force it to rely on a simpler primary model for the initial idea?
It's a valid mathematical critique, and it comes down to the concept of the Sharpe ratio.
The metric that defines how much return you get for every unit of risk you take.
Right. If you force the massive secondary model to search for the directional signal in a sea of thousands of variables, it is highly prone to finding false temporary correlations. The search space is simply too wide.
It gets lost in the noise trying to find the signal.
Exactly. But by using a simpler primary model, say one grounded in proven economic theories of mean reversion or momentum, you constrain the initial search space. You find a foundational signal that makes logical sense.
Okay. And then?
Then you unleash the massive computational power of the secondary model strictly on the problem of filtering. The secondary model isn't looking for a needle in a haystack. It's just examining the needles the primary model already found and deciding which ones are sharp enough to use.
That is brilliant. And mechanically, how does the secondary model actually dictate the execution?
Well, neural networks can output probabilities using something called a sigmoid function, which squashes the final calculation into a number between 0 and 1.
So let's say the primary model says buy.
And the secondary model analyzes the market structure and outputs a probability of 0.85. The execution algorithm takes that 0.85 and uses it to size the position. It says the meta model is 85% confident, allocate maximum capital.
But if the secondary model outputs a probability of, say, 0.51,
It effectively says, this idea barely has an edge over a coin flip. The system either passes entirely or sizes the position so small that it carries negligible risk.
it drastically reduces false positive entries, which mathematically catapults the Sharpe ratio of the backtest. It is just a phenomenal way to structure an algorithm.
It really is.
But wait, this brings us face to face with the biggest contradiction in this entire landscape.
Oh, I know where you're going with this.
We just established that the secondary model is this massive, complex, deep learning network looking at thousands of variables. And a few minutes ago, I asked if a hyperflexible model just memorizes the noise, like a student memorizing a practice test.
And I said regularization helped.
Right. But is regularization really enough to stop a model with 10,000 parameters from completely overfitting a data set of only like 1,000 days?
According to classical statistical theory, absolutely not.
Right.
Classical theory states unequivocally that as your model complexity grows beyond a certain point, your out-of-sample error must explode.
But the sources we are exploring today introduce a paper by Kelly et al., published in 2022, that proves something so mathematically paradoxical, it requires us to completely rethink everything we know about modeling.
Yes.
This is the exact paradox I teased at the very beginning of the deep dive. The idea of having more parameters than data points. I need you to break down the math of this because it sounds impossible.
Let's start with the classical limitation. In traditional econometrics, usually relying on ordinary least squares regression, you create a matrix of your variables and your data points. To solve the equations and find the optimal weights for your model, you have to invert that matrix.
Okay, matrix inversion.
Mathematical law dictates that if you have more columns, meaning variables, than you have rows, meaning data points, the matrix becomes what is called singular.
A singular matrix, meaning there is no unique mathematical solution.
Exactly. If I give you two equations with two unknown variables, you can solve it. If I give you one equation with three unknown variables, there are infinite possible solutions. The math breaks.
Therefore, the golden rule of traditional finance has always been to keep the number of parameters, let's call it P, strictly smaller than the number of trading observations, let's call it T. You must operate where P is less than T.
Keep the model simple. Keep the variables low.
But Kelly and his team, using advanced random matrix theory, proved that for predicting financial returns out of sample, investors should actually use the largest approximating model they can computationally compute.
They advocate for the regime where P is vastly greater than T.
They are explicitly saying if you have 1,000 days of historical market data, you should use a neural network with 10,000 or even 100,000 parameters. How does the variance not instantly explode? How does it not just perfectly memorize every single micro fluctuation of the historical noise?
Because in this high complexity regime, we abandon ordinary least squares entirely and rely heavily on aggressive regularization, specifically techniques like ridge regression.
Ridge regression.
Ridge regression fundamentally alters the math. It adds a small artificial value to the diagonal of that singular matrix we talked about. By adding this tiny bit of mathematical bias, it forces the matrix to become invertible again. It allows us to calculate a solution even when P is greater than T.
But just because we can calculate a solution doesn't mean it's a good one. How does it actually prevent the overfitting? We talked about the L2 penalty earlier. Let's dig into the mechanics of that penalty.
The L2 penalty in ridge regression is the secret engine here. When the model is training, it calculates an error score. The L2 penalty takes the value of every single weight the model assigns to a variable, squares that value, and adds it to the total error score.
It squares the weights. Why is squaring them so important?
Because of how squaring amplifies large numbers.
Yeah.
If a model decides that rain in London is the absolute most important variable, it will assign it a massive mathematical weight. But the L2 penalty squares that massive weight, which creates an astronomical artificial error score. The optimization algorithm sees this massive error and is forced to shrink that weight back down toward zero. The L2 penalty aggressively punishes extreme reliance on any single variable, effectively crushing the impact of spurious, noisy correlations.
So it forces the model to distribute its predictive power across thousands of tiny, robust, generalized variables, rather than a few massive, likely overfitted variables.
Exactly. And the theoretical breakthrough from the Kelly paper explains why this P greater than T regime is so profitable. They proved that forecast error in these models comes from a trade-off between two specific biases: misspecification bias and shrinkage bias.
Okay, let's define those carefully.
Misspecification bias occurs when your model is too simple to capture the true complexity of the real world. An ARMA model has massive misspecification bias because the financial market is not a simple linear equation.
And shrinkage bias.
Shrinkage bias occurs when your regularization penalty is so strong that it accidentally crushes genuine true signals alongside the noise.
So you are caught between a rock and a hard place. If you make the model simple to avoid the matrix breaking, you suffer misspecification bias. The model is just too dumb to understand the market.
Right.
If you make the model huge but penalize it heavily to prevent overfitting, you suffer shrinkage bias. The penalty accidentally kills the real signal.
And here is the punchline of the Kelly research. They proved mathematically that in financial forecasting, misspecification bias is vastly more detrimental to your out-of-sample Sharpe ratio than shrinkage bias.
Oh, so the damage caused by having a model that is too simple is mathematically worse than the damage caused by having a regularization penalty that is slightly too aggressive.
Precisely. This leads to what the text calls the Goldilocks model. You build an absolute behemoth of a model, thousands and thousands of parameters. By making it massively complex, you drive your misspecification bias down to near zero.
The model is finally complex enough to capture the insane, nonlinear realities of a global financial market.
But because it's so massive, it inherently wants to overfit.
Exactly, so you apply a massive, aggressive L2 ridge penalty. Yes, you introduce some shrinkage bias, and yes, you might accidentally suppress a few minor true signals.
But the mathematical trade-off is definitively in your favor. The behemoth model, aggressively restrained by regularization, achieves the highest possible out-of-sample portfolio performance. It is a complete paradigm shift from classical statistics.
That is genuinely fascinating. It fundamentally changes how you would approach building an algorithm. Your instinct is always to simplify, to find the one or two elegant indicators that explain everything. But the math says elegance is a trap.
Elegance is definitely a trap here.
You want a chaotic, sprawling matrix of thousands of indicators held together by a mathematical chokehold of regularization.
It is the triumph of brute force computation combined with strict mathematical discipline over human-designed elegance.
Okay, so let's take inventory of our system so far. We are feeding it volume bars to normalize the data distribution. We are using the triple barrier method to teach it dynamic, volatility-adjusted risk management. We have a meta-labeling architecture where a primary model pitches ideas and a massive regularized secondary model operating in that P greater than T regime filters those ideas to maximize the Sharpe ratio.
The backtest is flawless. The simulated equity curve goes straight up.
But then you connect the system to a live brokerage account, and we hit the ultimate barrier, execution.
Yeah, the transition from a simulated backtest to a live automated trading environment is the graveyard of quantitative algorithms. A model that prints money in simulation can bankrupt a fund in live trading within weeks.
And we need to explain mechanically why this happens, because from a layperson's perspective, if the supercomputer says buy at $100, you just send the electronic order and you buy it at $100. What is the disconnect?
The disconnect is market microstructure, specifically the mechanics of the limit order book, or the LOB. When you look at a stock price on TV, you see a single number. But the real market is not a single price. It is an instantaneous double auction.
The limit order book is a constantly shifting, massive queue of limit orders.
Yes, On one side, you have the bids, people waiting in line to buy at various prices. On the other side, you have the asks, people waiting in line to sell.
The gap between the highest bid and the lowest ask is the spread.
Correct. When your backtest says buy at $100, it assumes you magically acquire the asset at that exact mid-price. But in the real LOB, you have two choices. Choice A, you use limit order. You place your order at $100 and join the back of the queue.
You have to wait for a seller to aggressively cross the spread and sell to you.
And in a fast-moving algorithm, by the time you reach the front of the queue, the price might have already moved away from you, and you get no execution at all.
You missed the trade entirely because you were too passive.
Choice B, you use a market order. You demand instant execution. To get it, you have to cross the spread and buy from the lowest available resting limit order, which might be at $100.05.
You immediately pay a premium.
And if your automated system is trying to buy 10,000 shares, you will chew through that first level of the order book and start buying shares at $100.10, $100.15.
This is market impact. The sheer act of the algorithm trying to enter the market changes the physical structure of the market against its own interests.
Exactly. Supervised machine learning, the classification and regression models we've been talking about, they are static. They look at inputs and predict a label. They assume the environment is stationary and unaffected by the model's own actions.
They cannot comprehend market impact or queue position.
Furthermore, the text points out a fascinating mathematical complication that arises from our earlier breakthrough: volume bars.
Right. If we aren't using the clock, execution gets really weird.
It creates what is called a stochastic clock, or a random clock. If your metal-labeled system determines a trade is optimal and says, open a position now and close it after 50 volume bars, your execution engine has literally no idea when an actual clock time that will happen.
Because 50 volume bars could print in 12 seconds during a volatile open, or it could take 3 hours during a midday lull.
So your execution algorithm is stranded. It has a mandate to buy, but it doesn't know how fast the market is moving, it doesn't know its queue position, and it knows its own orders will move the price. How on earth does an automated platform solve this?
Yeah, how does it?
This is where the cutting edge of the industry moves away from supervised learning and deeply embraces reinforcement learning, or RL.
Reinforcement learning.
Yes, it is structurally designed for what are called model-free stochastic control problems.
Model-free stochastic control. We need to unpack that. Contrast it with the supervised learning we've discussed so far.
In supervised learning, you give the algorithm historical data and known labels, and it tries to map the data to the labels. In reinforcement learning, you don't have predefined labels.
So what do you have?
Instead, you create a digital environment, a simulated limit order book that perfectly mimics the latency, the queue dynamics, and the market impact. Then you deploy an AI agent into this environment.
The agent isn't trying to predict a price label.
No, it is trying to learn a sequence of actions that will maximize a cumulative numerical reward over time.
It's similar to training a dog, or maybe more accurately, training an AI to play a complex video game like StarCraft or chess. You don't program the physics of a frisbee into a dog's brain. You throw the frisbee, and when the dog catches it, you give it a treat.
Exactly.
Through trial and error, the dog's brain updates its internal neural pathways to optimize the physical actions required to get the treat.
That is the exact mathematical framework. In trading, the environment is the state of the LOB. The state matrix might include the current spread width, the volume imbalance between bids and asks, and the agent's current inventory.
And the actions available to the agent.
Are placing a limit order at various depths, placing a market order, or canceling an existing order.
And what is the treat? What is the reward function?
The reward is typically the final realized profit of the trade, strictly minus transaction costs, minus the spread paid, and minus a mathematical penalty for taking on too much inventory risk for too long.
So how does the agent actually map states to actions? Is there a specific mathematical engine driving this?
Yes, the sources specifically highlight tools like Q-learning. In Q-learning, the algorithm attempts to build a massive matrix called a Q table. Or in the case of deep Q learning, it uses a neural network to estimate the Q values.
What's a Q value?
A Q value is essentially the expected future reward of taking a specific action in a specific state.
Let's visualize this. The RL agent is sitting in the market. The meta model has told it to buy 10,000 shares. The agent looks at the state of the LOB. Let's say the spread is unusually wide right now.
It queries its neural network for the Q values of its possible actions. It might calculate that the Q value of using a massive market order right now is deeply negative because crossing a wide spread for 10,000 shares will incur devastating market impact costs.
The reward function would punish it severely.
Exactly. So it looks at the Q value for placing a passive limit order at the bid.
And that key value might be higher, but there is a probability it won't get filled.
Through millions of simulated episodes, the RL agent inherently learns the optimal policy. It might learn to slice the 10,000 share order into 50 smaller orders. It learns to post limit orders when the book is thick and aggressive market orders when it detects the momentum is shifting so fast that waiting in the queue is a guaranteed failure.
It essentially turns market execution into a dynamic, multi-step video game rather than a static prediction. It learns the physics of the order book without a human ever having to write a hard-coded rule about spread width.
And it perfectly solves the stochastic clock problem. Because the RL agent is continuously monitoring the environment and updating its actions step by step, it doesn't matter if the 50 volume bars take 10 seconds or 10 hours. The agent adapts its execution pacing in real time based on the flow of the environment.
This is an incredible architecture we've built here. We have volume bars feeding dynamic triple barriers, analyzed by a meta-labeled, regularized deep learning network, with the final execution handled by a reinforcement learning agent playing the order book like a grandmaster. It is a masterpiece of quantitative engineering.
It really is.
But there is one final massive hurdle, and it's not a mathematical hurdle, it is a human one.
Yes, the black box problem.
Exactly. Imagine you have built this masterpiece. It is trading live, managing hundreds of millions of dollars of institutional capital. Suddenly, on a random Thursday, the reinforcement learning agent liquidates a massive position, crosses the spread, and incurs a $1 million loss.
Ouch.
The chief risk officer, or the regulator from the SEC, walks into your office and demands to know, why did the algorithm execute that trade?
And if your answer is, the multi-layered deep neural network operating in a hyperdimensional space with an L2 ridge penalty determined that the Q value of liquidation was optimal, you are going to lose your job.
And your fund will likely face regulatory shutdown.
Yes. The 2024 to 2026 systematic reviews in our source stack are very explicit about this. They highlight interpretability as one of the most critical ongoing challenges in computational finance.
You cannot deploy a fiduciary system that you fundamentally cannot explain.
If a model is a complete black box, you cannot effectively manage its extreme tail risks because you don't know what market conditions will trigger catastrophic behavior. You must have a way to audit the logic.
So how do we crack open a model that has 10,000 parameters interacting in nonlinear ways?
The systematic reviews point to a revolutionary subfield called explainable AI, or XAI. And specifically, the gold standard tool being integrated into these financial systems is called SHAP, which stands for Shapley Additive Explanations.
Shapley. That name comes from game theory, doesn't it?
It does. It is rooted in cooperative game theory, originally developed by the Nobel laureate Lloyd Shapley in the 1950s. Shapley was trying to solve a specific mathematical problem. If a group of players cooperate to win a game and receive a payout, how do you fairly distribute that payout among the players based on each individual's actual contribution to the victory?
Because some players carried the team, some players just rode the coattails, you need a formula to calculate exactly who did what.
Right. Shapley developed a mathematically rigorous way to calculate the marginal contribution of every possible combination of players. In the context of our machine learning black box, we adapt this theory.
How does that work?
The game is the final prediction the model makes. The payout is the probability score it outputs. And the players are the thousands of technical indicators, volume bars, and macroeconomic data points we fed into the model.
So SHAP values run a complex mathematical audit to tell you exactly how much credit each specific variable deserves for a specific prediction. Mechanically, how does it figure that out?
Conceptually, the SHAP algorithm systematically perturbs the inputs. It takes a specific trade decision and repeatedly recalculates the neural network's output while randomly hiding or scrambling different variables.
Like asking, what would the model have predicted if it couldn't see the moving average?
Or what would it have predicted if it didn't know the volatility? By measuring how much the final prediction changes when a specific variable is removed across all possible combinations, it isolates the true marginal contribution of that feature.
It breaks down a hyper-complex deep learning output into a human-readable ledger. It says, the model decided to sell because momentum accounted for plus 40% of the decision, order book imbalance was plus 30%, and a drop in volume was plus 20%.
Exactly. And the sources actually provide a fascinating real-world example of this. They include a feature-important scores chart derived from running SHA analysis on a highly complex deep learning financial model.
And the results are incredibly validating for anyone who has studied traditional market mechanics.
Very validating.
What did the SHAP values reveal? When you crack open the AI, what is it actually looking at?
Despite the model having access to incredibly abstract, complex data transformations, the SHAP analysis proved that the internal logic was heavily dominated by traditional, classic technical indicators.
Like what?
The top drivers of the model's predictions were the Relative Strength Index, specifically RSI 14 and RSI 30, the Commodity Channel Index, CCI 20, and momentum over a 10-period lookback.
That is brilliantly ironic. We built an impossibly complex, regularized AI superbrain, operating in dimensions humans can't even visualize, and when we interrogate it with Nobel Prize-winning game theory, we find out it is heavily relying on the RSI, an indicator invented by J. Wells Wilder in 1978 that literally every retail trader has on their basic charting app.
It is deeply ironic but mathematically profound. The AI isn't just mindlessly using RSI like a retail trader might. It is evaluating RSI within a massive matrix of nonlinear interactions. But the fact that the SHAP values rank these classic indicators so highly proves that things like mean reversion and momentum are genuine structural realities of the financial market.
The AI, completely free of human bias, independently verified that these classic indicators contain robust mathematical signal.
It is the ultimate bridge between human intuition and machine computation. We are using the computational brute force of deep learning to capture the complex nuances, but we're using SHAP to translate the machine's final logic back into a language that a chief risk officer can understand.
It allows developers to perform vital sanity checks. If you run a SHAP analysis and discover your automated fund is making massive allocations based entirely on an obscure, irrelevant variable that has no economic rationale, you immediately know your regularization failed and your model is overfitted.
It provides the transparency required by regulators without forcing us to revert back to those brittle, oversimplified ARIMA equations we discussed at the very beginning.
We have covered a monumental amount of architectural ground today. We have essentially blueprinted the anatomy of a state-of-the-art automated backtesting and execution engine. Let's trace the full pipeline one more time to solidify how these pieces interlock.
Okay, the entire journey begins with rejecting the fundamental assumptions of classical econometrics. We accept that the data-generating process of the market is unknown, and we embrace non-parametric machine learning models focused exclusively on out-of-sample prediction.
To feed those models, we abandon the human construct of time. We replace fixed daily or hourly charts with activity-based volume and dollar bars, forcing the sampling rate to adapt to the true information flow of the market and stabilizing the statistical distribution of our data.
We then redefine success and failure in our historical data using the triple barrier method. We implement dynamic, volatility-adjusted profit and stop-loss limits, ensuring the algorithm learns the path-dependent reality of risk management, rather than just guessing a fixed point in the future.
We deploy a meta-labeling architecture to conquer the bias-variance trade-off. We let a simple primary model hunt for directional signal, and we unleash a massive secondary model to independently assess the probability of success, drastically reducing false positives and maximizing our Sharpe ratio.
We lean into the counterintuitive paradox of the Goldilocks model. We intentionally build architectures where the parameters vastly outnumber the data points to eliminate misspecification bias, and we control the chaos using strict L2 ridge regularization to crush spurious noise.
To cross the chasm from simulated backtest to the live limit order book, we transition to reinforcement learning. We train autonomous agents using Q-learning to navigate the stochastic clock, manage market impact, and dynamically optimize Q position.
And finally, we secure the entire system with explainable AI. We use Shapley values from game theory to dismantle the black box, ensuring our complex models are grounded in measurable, economically logical market realities.
Whether you are a retail quant trying to optimize a Python script in your garage, or simply an observer trying to comprehend the invisible algorithmic forces that are manipulating global liquidity every millisecond of the day, the overarching lesson here is clear. The architecture of financial reasoning has fundamentally evolved.
And if we step back and connect this to the broader trajectory of finance, it becomes clear that machine learning is not just a faster calculator for old ideas. It's a completely new paradigm of epistemology. It is empirically driven, continuously updating in response to novel data structures, and entirely agnostic to the elegant but flawed economic theories of the past century.
It mathematically derives what is, rather than attempting to prove what humans think should be.
Perfectly said.
Which leaves us with a fascinating, almost existential problem for the future of markets. I want to leave you with a final thought to mull over as you digest this architecture. We are detailing the state of the art right now, but algorithms evolve.
That you do.
If every major institutional player on Earth adopts these optimized, regularized, meta-labeled reinforcement learning systems, if everyone is filtering out the noise with perfect efficiency, does the market eventually become so hyper-efficient that the algorithms themselves become the new baseline of noise?
That is the big question.
If the limit order book is entirely populated by competing Q-learning agents anticipating each other's moves in real time, what does an activity-based volume bar of the future actually measure? Are we still measuring the aggregate psychology of human panic and greed? Or have we engineered an entirely synthetic ecosystem where we are just photographing the invisible physics of machines trading against machines? Keep diving deep.